Good afternoon, everybody. I'm Jonathan White from Knowledge Bank. It's my absolute pleasure to have an opportunity to host this session this afternoon, with Zephyr. A great addition to the buy-to-let market, and I'm sure that today Andy Rowe, Regional Sales Manager, is going to talk us through a lot of aspects in terms of some of the challenges maybe that you have at the moment with your buy-to-let customers. I know that we're going to be looking at EPC regulation. We're going to be looking at appetite in the market to remain in the market from landlords, and we certainly have some intermediaries on the line who've got 80 to 90% of their business coming from buy-to-let. So there's some real knowledge here, and hopefully you can contribute to the session. We'll also cover limited companies and some of the challenges around there. I do have some submitted questions, but what I would ask is all the participants, if you just want to ask a question, please put it in the chat. I will endeavour to ask it, and we'll get at the most appropriate a good answer for you on that. If there's anything we don't know, we'll come back to. But I'm absolutely 100% confident that Andy will have all of the answers from all of your questions around the session today. So the only other thing to say is, apart from thank you for joining us, is that we will be doing some polls we've got 3 small polls. They literally are a couple of questions. It really just gives the lender a really good opportunity to understand the position of the participants. So it's really simple to do, but I shall be firing those up with efficiency during the presentation. So hopefully we can get there. Andy, over to you.
Thank you very much. Thank you for the fantastic introduction, Jonathan. That's great. Thank you. So my name's Andy Rowe. I'm one of 3 sales managers at Zephyr Home Loans. We have Mark Rookyard down in the south. I cover North London, East Anglia and the Midlands. And then we've got Elliot Newey, who covers the North. And behind us, we have some fantastic telephone BDMs that support us as well. They really are the backbone of our business, picking up a lot of the inquiries on a day-to-day basis. So big friendly team. If you can't get hold of the person in your area, then just reach out to someone else. We're always here to help, and we're always here to answer your questions. So just a brief overview of the team. All of our contact details are available on our website at zephyrhomeloans.co.uk, and we've also got a call centre as well that you can get through to. So there's plenty of opportunities to reach out to us to find out any questions that you may have. So first thing I'd like to do, hopefully that slide's changed, Jonathan, for you. Is just tell you a little bit about Zephyr. So if you're not familiar with us or you've not used us before, just a brief sort of summation of who we are and where we come from. So Zephyr was launched in 2018, and we're part of a wider group called Computershare. Computershare is a big share business, but a global giant in the financial services space. Within the UK, we have a business called Computershare Loan Services. Really brief potted history here. And within Computershare Loan Services, we have Topaz. Topaz is the largest lender that most of our guests today probably have never heard of. It's the regulated part of our business, but we're the 10th largest lender in the UK by volume. We've got a 40 billion back book, and a lot of the back book that we manage is old back book stuff like Mortgage Express and Northern Rock and this kind of stuff. So we've got a lot of history, a lot of knowledge in especially in the buy-to-let space. We also do servicing for other lenders as well, but back office servicing for mortgages once they've completed. So we've got a lot of expertise. And then Zephyr is the front end origination part of that business. But in addition, we have another business called Deposit Protection Service, which I'm sure many of our listeners today will be familiar with. Once you take a client deposit, you need to, or a landlord takes a client deposit, they need to put it into a recognised deposit protection scheme. Deposit Protection Service is the largest one of its type in the UK. We've got about 1.8 billion of tenancy deposits under management. So we have a lot of data about what's going on in the mortgage market, Jonathan. And one of the things that I want to do today is to get into some of that data. And we've driven some polls off the back of that. And hopefully it will prove really, really useful, because clearly we're in a difficult time at the moment in the market with funders, 2 main streams of funding in the market, retail and wholesale money. And, there's a lot of difficulty for a lot of lenders at the moment to keep abreast of the change, with interest rate changes being prevalent at the moment. So it's a tough market to stay on top of, and I know it's even tougher for the brokers tuning in and out there working in the market space, dealing with those changes that are coming at pace. And I know you guys have been trying to champion lenders signing up to a 24-hour notice period for product withdrawals. I'd like to stick my hand in the air and go, what a great idea. I think the simple reality is at the moment it's very, very difficult because, sometimes rates can change by, as we've seen recently, by 60, 70 bips in a day. And, it's just sometimes very, very difficult for lenders to be able to cope with that and be able to give notice. So it is a challenging market, but we'll talk about some of the positives that we're seeing through the DPS today, which I think will hopefully give the listeners some confidence in what we're seeing as a lender and a provider of the deposit protection service and what we see in the market. So moving on, first question I want to ask, and I think you're going to do this as a poll, aren't you, Jonathan?
I am. I'm going to fire a poll up and just read the question. As a percentage, as a proportion rather, of the average salary, what do we think that percentage is? A, 20 to 30, B, 30 to 40, or C, 40 plus. Now I'm going to launch the poll. Oh, fascinating responses straight away. I'd love to know where everybody is situated when looking at these answers as they come in. Just a few more seconds for a few more responses. Hopefully,
yeah, absolutely. This would be good to see.
A few people that haven't yet responded. Okay, I think we'll cut it there, shall we? So end the poll and share the results. So the results are that nobody says it's as low as 20 to 30%, which is really, really interesting. So I know the slides, so I know how this is going to play out. So if I can just click off that and hand back to you.
That's interesting, right? That's interesting. I would guess that a lot of our participants today are probably based in the southeast, judging by those answers, which is great. So so this is we did a landlord survey recently. And these are the trends that we're seeing through the deposit protection service, right? So it's probably no great shock to anyone on this call to know that the lowest income to rent percentages is in Scotland, quickly followed by the northeast, right? So, actually it's northeast followed by Scotland. So probably not a massive shock to people that are on this call. And we certainly have seen more and more people in the landlord space looking to diversify their portfolios by looking at properties in the north, because property values are lower and the yields can potentially make more sense when you're trying to buy, and potentially it's more affordable for people in the north in terms of looking at the percentage. Probably also not a great shock to know that London's the highest there at just over 44%. So that poll, actually, the answers we got are pretty accurate, right? One of the ones that shocked me actually was the southwest, because I'm from Cornwall. If you can't hear it in the accent, about 34.5%, which is just sort of suggests that there is a lot of rental property down there, and we see a lot of people that buy properties in the southwest as retirement homes or second homes. So I think that's driven up the rental prices in the region quite significantly. That's my opinion, not the rental. Not the DPS opinion, as a local from Cornwall. That's kind of what I see. So that was quite an interesting result when I saw that. So I think the poll was pretty accurate, Jonathan. So it tells me that our guests today are very much on point with what they're seeing in their own practices. So it is interesting, and I think it's going to be an interesting time over the next 6 to 12 months as we still see the volatility in the market, and we look at where buy-to-let currently sits. And for a lot of borrowers now, when you look at rental incomes against what you can borrow, loan to values have dropped to sort of 45-50% in terms of serviceability through rent. And I think we're seeing rentals always play catch up. I think we've seen house prices go up significantly. We've now seen the interest rate changes, and because the borrowing is effective, we're now starting to see the rents creep up. So be really interesting to see where these statistics lie next year when we do our next poll, just to see if these have changed. My personal opinion is I think they probably will, because rents have to increase for landlords to continue to see affordability. So I think it's inevitable that will play out through the rental space. So quite an interesting slide, and as I say, it'd be good to see where we're at next year on this one.
Andy, if I can just add in there, Andy, I think that there's been a lot said about the increasing concern of job security as well. So that obviously plays a part when so much of somebody's income is related to their investment portfolio. job security and how much that's starting to consider make a dent in the considerations of the lenders?
That's a great question. And I don't know if I'm the right person to answer it, because as a lender, we work in the buy-to-let space. So we're not dealing with residential buyers, and we're not seeing the impact that's playing out through the residential space in the same way as a residential lender maybe would. I think there is no doubt that there is affordability challenges throughout the market. And we've seen certainly in the mortgage industry that there have been redundancies and shifts in the mortgage industry. So the mortgage industry is generally one of the first industries to get affected when there's any kind of climate change in the financial space, which then later tends to play out through other sectors, right? So if I had to hazard an educated guess, I would suggest that we are likely to see a period of difficulty for people in the market space. And I think you've got two challenges, right? You've got the affordability within the mortgage space, which is clearly being affected at the moment. And as people come out of, and I put myself in this position, right? I'm coming out of a long-term fixed next May at 1.84, and I'm staring down the barrel of probably 4+% on my next mortgage rate. Now, I'm quite lucky because I'm at the tail end of my mortgage and it's repayment, so the impact is not going to be so big. But for people on newer mortgages, then it's going to be difficult. And there is an anticipation through the mortgage space that there will be arrears in the market as we move forward with the cost of living crisis, etc. So I think there are going to be some challenges. I think businesses are also being affected. I've got friends locally that run businesses that have been massively impacted by rate rises and utility price rises. That then affects their income through their business, and staff are asking for increases in pay. So it's a double whammy, right? But it doesn't necessarily translate that their income is going up in their business. So that could result in redundancy. So I think there's a lot of babble there, but I think it's going to be difficult, and it wouldn't surprise me if we did start to see that play out. So some difficult times ahead, no doubt.
Okay.
So this is some data from the poll that we did, right, which I think is quite interesting. And I just wanted to share this, and I'm sorry, I'm looking. I don't know if you can see me in this, but I'm sorry, I'm looking at two screens, guys. If you see me looking away, but I think the first thing that's quite interesting, right, is if you look at. So we had a lot of respondents to this survey when we ran it, okay, and we've 2,620 respondents, and we've broken it down to 1 property, 2 to 5 properties, 6 to 10, and 11 plus, right? And the semi-professional, we're sort of saying, is between the sort of 6 to 10 and the professional 11 plus. But what's interesting here on the will you leave the rental market, right? So that if you look at the top line, you'd go, oh, that's quite a scary statistic. 66% of amateurs are saying yes, 39% of semi-professional, 31% of professional. But actually, I think the more interesting statistic is actually, if you look at the professional space, okay, the vast majority of professional landlords are looking to stay in the space. So we get doing the job that I do when I go out and speak to brokers often sort of say to me that some of their landlords are looking to vacate the space. But actually, if we look at what we're seeing specifically through the DPS, at the size of our deposit book isn't really changing. So as I said to you at the beginning, we've got 1.8 million of tenancy deposit money under management, and that doesn't really change. And actually, some other interesting statistics is that we're finding tenants are staying longer in properties, going out from over 700 days to over 800 days. So I think landlords are starting to look after tenants better. They're keeping them longer. Tenants want some security of property, so they're not moving around as much. But we're certainly seeing that the vast majority of professionals are looking to stay in the market space. And actually, on top of that, interestingly, is a lot of professional landlords are looking to buy over, or 70% are looking to buy within the next 2 years. So, I think as we maybe see the demise of the dinner party landlord, and I'll hold my hand up and say I'm one of those, I've got one property and I'm thinking, is it worth me keeping? As we see some amateurs move out of the market, I think it's an opportunity for professionals to pick up more stock. Because the reality is, and I'll use my situation as a good example, putting my property on the market doesn't necessarily put it in the hands of the first-time buyer, right? Because I spoke to my tenant about buying the property, and there just wasn't the affordability there for her to buy. And I think as stock becomes available, won't necessarily, unless the bank and mum and dad step in and support purchases, then it doesn't necessarily translate that those properties coming in the market will go to first-time buyers. So I think the rental space will broadly stay the same, but I think we'll see more professional landlords develop into the space. Again, that's my opinion from what I hear and what I see, but it'll be interesting to see how that plays out at the DPS over the next couple of years. So quite interesting, I think. EPC. So let's just talk a little bit about EPC. Do you have any questions you want to jump in? Because I know you said at the beginning, Jonathan, there were some questions. I don't know if there's anything on that rental piece that you've had any questions so far.
The forward questions weren't necessarily around that. They were specifically different. I mean, there was one around the cover, the pressure under the and I haven't got the question in front of me at the moment because I've just closed the spreadsheet.
Oh, sorry.
I can come back to it if you wish, but it's around the interest cover ratio is starting to get stretched. Not sure if you've seen that question, but do you want to pick that up now or?
Well, if you find it so you can read it to me,
yeah.
and then we'll come back to that. Let me go through the EPC stuff, and then we'll come back to that question. Sorry, I'll put you on the spot there, but
that's fine.
So as far as EPC, you know, EPC is coming down the track, right? We know it's coming. It's in Europe. It's in the UK. What we're not 100% sure of yet is exactly when all of these dates. I mean, these are the proposed dates, right? So all rental properties have to be between an A and a C. New tenancies by 2025, existing tenancies by 2028, right? Now that's the proposal at the moment. There's a lot to do. There's a lot of work to do. There's a lot to think about before we get there. I guess the challenges around that are that, you know, for individual landlords, you know, sitting there at the moment thinking about this, they're not necessarily sure what their property, what they have to do to it to get it to an EPC to a C, right? And the interesting thing is that 60% of the housing stock in the UK is D or below. So it's a big proportion of housing stock in the UK is not currently at regulation. So there's clearly some work to do here. And you know, from a landlord's perspective, the real benefit is for the environment and the tenant, right? Not necessarily for them as the owner of the property. Clearly, we all want to see greenhouse gases reduced and global warming, you know, start to change. But in terms of, you know, money in your pocket, you know, this is a cost to the landlord that doesn't necessarily specifically benefit the landlord. It will do at the moment because a lot of lenders like us offer a discount on products that are EPC A to C. You get a 10-bit discount, so you'll feel that return on investment immediately in your pocket from a reduced rate. But I guess the long-term thing to think about here is that if we get out to these dates and you haven't done the work on the property as a landlord, then what we don't know is what the penalties may look like, right? You know, it may be that you have to take your tenant out of the property while you get it up to the appropriate rating, which could be potentially a loss of income. So there are potential consequences moving on. So I think, you know, this is definitely coming. We need to think about it, and we need to think about how we're going to deal with it. And actually, what's interesting is that the global guess is that, you know, the cost of upgrading is going to be anywhere between, we've got 35 billion on there, but it's actually it is a guesstimate between 35 and 65 billion, right? So it's a huge cost to getting this done across the UK, and this actually includes all housing, not just buy to let, of course. But from a landlord's perspective, I guess the opportunity now from a broker's perspective, the opportunity is you need to be speaking to your landlords about these changes. And they need to be thinking about, if I have work to do to my property, where am I going to get the money from? And, you know, it's our guess that a lot of this cash, of course, will come from lenders, right? We'll be financing properties and capital raising for people to do work to their properties to get them up to an EPC rating of C or above. So, you know, I would argue that, you know, it's probably worth thinking about it now, because if you go onto a long-term fixed rate, and then you look to remortgage, you might have to take a further advance, or if you're a lender with you can't take a further advance, you need to go to maybe another property to get the money. So it's that point now where we really need to start thinking about this hard and fast, about where the solutions lie and how landlords are going to get this work done. So time for another poll then, Jonathan, I think.
Okay, just bear with me. That's great. So we've got the poll. Okay, the question is, can you read the question?
Yeah, what percentage of landlords are aware of the proposed EPC regulations? We've got 67%, 82%, or 92%.
Launch poll 2. go. Andy, there was one question that hopefully you can answer now.
Yes, go.
Somebody asked whether you take an F-rated EPC. I guess I probably know the answer to this, but do you want to?
Yeah, no, you do know the answer, and it's a no. I mean, we only go down to an E currently.
Yeah. Okay.
And I can't think of a lender specifically off the top of my head that would do that. I'm sure you guys have got that answer within your bank information. But for us, no, we are A to E currently, and we discount from A to C by 10 bits across our product range.
Okay. I'll use my stock answer there, and that's that if you go into Knowledge Bank, it certainly will give you the answer to that. So we'll do that in a second, I think. Okay, so I've given that time. I'm going to share the answers, or the responses rather.
Interesting again. Yeah, so a lot of people thinking that landlords aren't aware. So let me bring up the answers, because I think this is quite interesting, got an interesting question, and it plays out around professional, amateur and semi-professional. So professionals are on the ball here. You can see that 92% are aware of changes. So clearly professional people, as you would hope, I guess, and would probably expect, are aware of what's going on in their industry. This is a full-time job. They should be on top of the stuff that's going on. There's lots of regulatory change in the market currently. So, you know, you would expect that. And probably then, therefore, no great surprise that a much lower percentage of amateurs are aware of the changes in EPC regulations, but still good that 67% are aware of what's going on. So that's good. But I guess what's more interesting about this is what the opinion is of landlords in terms of are they concerned, are they not concerned, and there is quite a bit of concern, especially in the professional space. Which again, I guess if you think about it logically, kind of makes sense, because if you're a professional landlord with 10, 15, 20 properties, then the potential impact on cost to you is much greater than an amateur landlord who's only got 1 or 2 properties. So again, you'd expect the poll to play out that way, which, you know, comes back to what I was saying on the previous slide, that I think it is a massive opportunity for us and as an industry to be talking to our landlord clients, or your landlord clients, about the changes and how they can facilitate change ahead of the game, right? And you know, I got asked a question a little while back, Jonathan. You know, if we give advice to a landlord to capital raise on their mortgage to finance the cost of bringing the property to a C, and then there are grants available, would we be at risk of giving poor advice? I don't think you are. For me, what is the advice? The advice is this change is coming, and you need to think about how you're going to deal with it. There may be grants, we don't know, but you know, at the end of the day, you have to think as a landlord. You have to make a decision about what you're going to do with your property. Now, you can wait to see if there are grants available, but if there aren't, you know, it could be you could be in a position where you've got very short time to get these properties up to speed, or you could start acting now and get it done. So I think you put the burden of responsibility in terms of making a decision on the client, but you arm them with all the facts, right, so that they can make an informed decision on what they want to do. But clearly, it is of concern, and you know, people need to start thinking about how they're going to deal with the problem and move it forward. So, okay. So a little bit about what we see from the DPS, and now probably moving into a little bit of criteria about us and what we do. So firstly, what do we lend against? So probably no great surprise what you're seeing there. So we lend against houses and flats. We'll lend on leasehold houses, leasehold flats. We'll lend on freehold houses. We won't lend on a pure freehold flat though, okay, just so we're clear on that, unless it's a multi-unit freehold block, which we will lend against. But with flats, Jonathan, we have no height restriction on block. I know a lot of lenders have up to 10 stories within the M25 and up to 8 outside, or similar type of situations. We have no height restriction. If it's over 10, we just want to sensor check it first. But you know, we've lent on 35-story blocks, 40-story blocks. So you know, absolutely within remit for us. Not only that, if it's ex-local authority, we will do it. So if it's a high-rise ex-local, we'll do it. Not only that, if it's got deck access, we'll do it. So we've got a lot of flexibility around flats, and we obviously do a lot of work with flats, as the big part of the rental market is flats, as you would expect. So I think we're a really good home for those type of inquiries. The only thing with flats, guys, two things to really just have in the back of your mind. Firstly, lease length. Okay, we want 70 years left on the lease at the end of the mortgage term, so just be aware of that. And secondly, percentage in private ownership. So if you are working with an ex-local authority block, we do want 50% to be in private ownership. Now, the valuer will pick that up when they attend the property and give us their opinion. But you can use a website called streetcheck.co.uk, which is quite a useful tool. It doesn't specifically tie into the exact property, but it tells you information about the local postcode areas. So it gives you a really good guide to what's going on in terms of private ownership, private owned with mortgage, private owned without mortgage, housing association, council owned, etc. So it is quite a useful tool, streetcheck.co.uk. We also lend on HMOs and multi-unit freehold blocks. Now, unlike some of our peer lenders that go up to 10 room HMOs and 20 unit blocks, we do 6 bedrooms or 6 unit blocks, but we're very good at it. So just let me tell you a few of the things we're good at, right? So let's talk about HMOs firstly. We'll do unlicensed and licensed properties. Obviously, if there's a license required, we will want to see the license. And actually, as you're probably all aware on the call, it's mandatory licensing for 5 or above, but sometimes some local authorities require licenses on smaller properties. But so if there's a license required, we'd want to see that. As I say, we've got up to 6 bedrooms. In terms of room sizes, they have to conform with the regulation. So standard regulation on that. We will do though, locks on doors, no locks on doors. Okay, some lenders have preference either way. We'll do a single AST across the whole building, or we'll do a multiple AST. So if you've got 6 students, and we'll do students, DSS and professionals, right? So if you've got 6 students in a property and they're on one AST, for instance, that's absolutely fine. Or if you've got 6 professionals in there, each on an individual AST, that's fine too. We'll do that. We'll do bathrooms in the rooms, not a problem. We will do multiple kitchens, but not kitchens in the rooms, okay? Because then it's classed as a bedsit. So if you've got a 3-story townhouse, for instance, with 2 rooms on each floor, ground, first and second, okay, and there's a kitchen on each floor servicing those rooms, we will consider that, subject to valuer's comments, of course, but that's within policy for us to consider. So a lot of flexibility around HMOs. We will allow communal space or no communal space, but again, it's dictated if the license wants a communal space, then we'd expect to see it. But if there's no communal space and there's no license required, we can look at that. Also, if it's a 4-bed and below, and it's on a single AST, we can consider on our standard range rather than our HMO range. Now, the downside of that is you have to use we would work on standard rental, not the HMO rental, right? So you get a slightly different ICR challenge there. And I know you had an ICR question, but you get a slightly different ICR challenge. But if it works on rental income, then it's potentially better for the client because they're getting a better deal. All right. So 4 bedrooms or below on a single AST. Multi-unit freehold blocks up to 6 on one title. We want the whole block, guys, right? So what we can't have is a situation where, let's say a landlord owns 6 properties on one title and he sold one off. So he's put one of the properties on a long lease and sold it off. We can't then secure a charge on that freehold block because there's a leasehold title in that block and we can't do it, right? So we want a clear title over the whole thing. So in that scenario, if you wanted someone like us to do it, you'd either have to put that one back on into the multi-unit freehold, or you'd have to put them all on leasehold and then remortgage them individually. That's what we would be looking for. Second thing to be aware of, and different lenders have different views on this, but for us, we want each property to have its own separate lockable entrance. Okay, I tell this story regularly, and it's actually a true story. I had a property in Yarmouth where you go through the ground floor entrance. The first flat on the ground floor had a door to the left to go in, so it had its own separate lockable entrance. You went up the stairs, you had to go through flat 2 to get to the door to go to flat 3, which is on the 3rd floor. Bizarre property, right? No one's going to lend on that I'm aware of, and who would on earth would want to live in flat 2? But there you go. So you do get these sort of weird things crop up. Additionally, they've got to have their own services. Okay, so I'm just going to try and explain this as clearly as I can. If you've got one set of services going into the building, gas, electric, water, and then each property's got a meter off that one set of services coming in, that's no good. Each flat has to have its own separate water supply, own separate gas supply, own separate electricity supply. And the reason we need that is if we ever get into a possession event, we may want to chuck long leases on them and sell them individually. And what we don't want to do is start installing services, right? So they have to have their separate services. Flats above commercial is another area we work in. It's that old chestnut of down to valuers comments, right? Which I know everybody's now cringing because I said that, but let me give you some clarity on how we work. So I think there are three things predominantly that you need to be aware of, guys, right? If the property is affected, first and secondly, by either noise or smell pollution, then it's going to affect the enjoyment of the tenant within that property. The landlord, the valuer is going to pick up on it, and it's going to be a no. So you just need to be aware of that, okay? So noise and smell pollution. So if it's above a chippy, if it's above a kebab shop, if it's next to a noisy football pub, something like that, then the chances are it's going to be a no. The third thing, which is not quite so obvious, but it comes up in these calls quite regularly, is very often you'll see a parade of shops where you've got the flats above and shops below, and the flats above have rear access, right? That's fine, but what you need to just be mindful or conscious of is if you get the big blue commercial waste bins to the rear, especially if you've got a food establishment, the valuer will see that, and they're concerned about pest pollution, right? So rats, mice, fox, whatever. And it can be detrimental to the enjoyment of the property. So that's something else the valuers pick up on. Now, we get a lot of inquiries, Jonathan, about flats above commercial. Generally speaking, we can give a yes or no on the phone, but every so often you'll get one come through and I'll sit there and I'll look at it. I'll go, do you know what? I'm not sure on this. So what we have the facility to do for you is to send the inquiry to the valuer. Okay. There's no charge to the client, no charge to the broker, right? And what's great about that is the valuer will come back and they'll give us their appraisal of the property, you know, in terms of what they think. And they'll look at historical data they have on that property or the area, and they'll be able to give us some guidance. And we get quite an in-depth report typically on that property. Now, if it's a no, it's a no, but we will share that report with you so that you've then got it to give to other lenders where you're trying to source, which is really, really useful. But if it's a yes, you know you're good to go and you haven't wasted client funds along the journey, right? Every so often we'll get a situation where the valuer will say to us, the property is acceptable, but it is going to be down to the valuer on the day to assess how it's impacted by that particular commercial or these particular commercials. So then it's sitting down and having an open, honest conversation with the client about, look, the property's okay, but this is the concern, and this is what specifically the valuer is going to be looking for when they arrive on site. So if you have any notion that that is going to be adversely affecting the property, you need to make that decision now before you spend your money, but you're armed with the facts, right? So you can make an informed decision. So hopefully that's useful, and please plug into that service, guys. And we also do new builds, of course. For us, new builds are properties that are either built or first occupied in the last 12 months. And that can be a bit of a catch out because it might have been built 18 months ago, but only first occupied 6 months ago. So we'd still class it as new build, all right? And we'll be looking for standard warranties, et cetera, which I won't get onto this call, but you know, if you've got one, give us a call. Who do we lend to? So we lend to individuals and SPVs. With SPVs, guys, well, with individual or SPV applications, is up to a maximum of 4 applicants, okay? Just want to walk through SPV applications and you'll know why as we move through the slides. But just quickly, there are 4 rules for SPVs, which are really useful to know. Rule number 1 is all directors must be on the application, even if they don't have a shareholding. Okay, we occasionally get directors that have no shares. All directors on the application to a maximum of 4. Second rule is directors must own a minimum of 60% of the shareholding. Rule number 3, shareholders that are not directors cannot go on the application. Rule number 4, shareholders that are not directors cannot own more than 20% individually. Right, so they're the 4 rules. I'm going to give you 2 quick case examples, which I think are quite useful. One is my personal situation, which isn't a live case, but it kind of explains our policy quite well. If myself and my partner were to buy a buy-to-let with our 2 kids, myself and my partner could be shareholding directors 30% each. So we're 2 directors, we go on the application, we're underwritten, and we sign the personal guarantees and take independent legal advice, right? But we meet rule number 2 because we've got 30% each, so we've got the 60%. My son and my daughter then can own 20% each, right, as shareholders. So they're shareholders, not directors, so they don't go on the application, so they don't get underwritten, they don't need an income, they don't need to own a property, they can be first-time landlords, first-time buyers, and they can go on that application, but they're not underwritten, right? We ignore them for all intents and purposes, right? and they both got 20% each, so they meet that rule. Why is that interesting in my family case? Well, firstly, my daughter is 20, so she's not old enough to go on a mortgage, but she can now own a property but not be on the mortgage, which is really useful. And my son, although he's a UK taxpayer, he works at sea, so he's outside of the UK for more than 6 months a year, so he doesn't pay tax. Even though he's a UK taxpayer, he doesn't pay tax. So quite hard to get a mortgage when you're a seafarer, as a lot of our guests will know today. So that's a really good example of how that can work quite positively. And actually, a live case is that we had an inquiry where we had 5 brothers. They were all foreign nationals, but 4 of them were in the UK with permanent rights to reside, which we accept. Okay, and they set up an SPV where they all had 20% each. Okay, so 5 brothers, 20% each. The 4 UK brothers were directors, so they went on the application and they were shareholders and they ticked that box. But the 5th brother lived in Dubai, right? He was a 20% shareholder. He wasn't a director, so we didn't underwrite him. And actually, he was a big earner, so he was in that position where he could put money into the company, and we'd be fine with that as well. So it can work really, really favorably the way our process is set up. We have no background restriction on portfolio size. So if you've got a landlord who's got 100 properties, 1,000 properties, 10,000 properties, we have no restriction on that. And we have a great background rental coverage. So as long as your landlord rental income is equal to or greater than the mortgage payment, it fits. So 100% rental cover. So a lot of lenders are covering at 125 at 5.5 or 125 at 5. We're just 100% rental cover. So that's really, really good. We got to 95 at the end of the term, 21 going in, 95 at the end of the term, up to 2 million loan size. We'll actually go much, not bigger individual loan sizes, but we can actually do much bigger portfolio lending, which I'm going to come to in a little bit. So just a couple of other things about how we look at people. So firstly, experience. If you go on to Knowledge Bank and look at whether we lend to first-time buyers for first-time landlords, it probably says yes, right? But let's clarify how that works. For a standard property, you have to have 12 months property ownership experience. So if you're doing a standard buy-to-let, as long as you don't have to be an owner-occupier. So let's say John lives in London in a rented property. He owns a property in Wales that his mum and dad live in, but he wants to do a buy-to-let in Hertfordshire. That's absolutely fine, provided he's owned that property in Wales for 12 months, he meets criteria. The only time we want rental experience is if you're buying an HMO or a multi-unit freehold block, then we want you to have 12 months letting experience. But if you've got business experience in a similar field, so let's say you're a letting agent or something like that, we can consider. But second, third, fourth applicant can be first-time landlords, first-time buyers. All right, so just be aware of that. From an income perspective, we expect applicants to have an income, but we have no minimum income criteria. But I just want to explain that in a bit of detail, Jonathan. We break income down effectively into 4 types. Employed income, so I don't know, you work for Tesco's as a delivery driver. Self-employed income, you're an accountant or an electrician or a plumber or whatever you are, and pension income. Now, if you have income from one of those 3 sources, we have a no minimum income rule, all right? Now, just to caveat that, we don't have debt to income ratio, but we do have prudent underwriting. So if you've got someone with really low income, the underwriter is completely within their remit to qualify that there is affordability there. So they may ask for bank statements to see how they manage their accounting in the background, okay? But we have a no minimum income policy. The 4th income type is landlord income. So this is where you've got maybe a professional landlord, or all of their income comes from landlording. We want to see £25,000 gross rental on their SA 100. So their SA 302 may show 6,000, but as long as their SA 100, so that's their gross rental before any deductions, equals 25,000, then they fit, okay? If you've got someone who's got multiple income streams, you don't have to declare all of them on the application. You only have to declare one. But for each one that you do declare, so if you're concerned that there is low income and you just want to back that up with other income sources, for each one that you declare, you do have to prove it through the document trail, so pension statements or pay slips or whatever it may be. Okay, so just be aware of that. Every applicant must have an income unless you have someone domiciled in the same home. So say you've got a husband and wife team, and I don't mean to be sexist here, but let's say husband's full-time employed and wife is at home, but wife may be looking after the buy-to-let portfolio in the background. We're fine with her not having an income because they share a home and they share the bills, and husband's got an income. So that's where we would consider someone without an income. All right. We'll allow top slicing. So I won't get into all the mechanics of how this works today, but if you've got someone that's got an income shortfall on their property, not enough rental to get what they need, we can consider a top slice from income. But we can also consider what we call cross-portfolio subsidization. This is where maybe you've got a landlord bringing 4 properties to Zephyr, 3 of them meet on the income side from rental, but one of them's short. So you can use the excess rental from the other 3 to top slice the one that's short. Okay, so we've got sort of multiple facets to our top slicing availability. Gifted deposits, gifted equities, intercompany loans, just quickly a little bit about those. So gifted deposits, we will allow gifted deposit from immediate family or gifted equity. Okay, so if you've got a client that's in that position, then we could be a good home for that for you. All right. And what I find, Jonathan, actually, when I get into cases is this sort of layering effect, right? Because you look at pricing, you think, well, that lender is more expensive than that lender, and why would I ever give a case to that lender because they're more expensive? Let's say you've got high-rise block, 15 stories, load of lenders are gone. Then suddenly you find it's ex-local authority, a load more are gone. Then you find it's got deck access, a load more are gone. And then you find it's an HMO and a load more have gone. Then you need a top slice. And then you've got a gifted deposit, right? All of those things we can do, right? And that's where this layering of difficulty starts to play into the hands of the specialist lenders in our space. And that's why, you know, we can be a really, really good asset when you are looking at placing a case, all right? We'll also do intercompany loans. So one of the questions I get asked frequently is, do we do company layering? This is where you have a parent company own shares in the SPV. We won't lend in that scenario where the SPV has a shareholder that's a company above. But generally what I find when I dig into these cases, Jonathan, is that the reason they're doing it is the company above has a significant sum of money in there and they want to use it for deposit funds, but they don't want to pull it out as income. So there is a way of doing that through an intercompany loan, right? So if you've got, let's say John and Mary own a company that's doing really, really well, and they've got 200 grand of cash in it, and they want to use it to buy buy-to-let property, all right? They don't want to pull it out as an income to pay tax on it. What they can do is they can lend it to their SPV, and provided the shareholders and directors are the same, they can lend the money across. Very tax efficient way of doing it. So they've now got an intercompany loan. It's not a director's loan. It is a director's loan of sorts, but we'll come back to that in a sec. It's an intercompany loan. Provided there's no repayment structure in place while our charge is on the property, then that's absolutely fine. Of course, when they remortgage in 2, 3, 4, 5 years time and maybe move to another lender, they can then start paying themselves back. They can charge interest on the loan, etc., etc. So it can be a very tax efficient way of moving money across. Director's loan tends to be in a situation where you have, let's say, Keith owns a property, wants to transfer it into his limited company. Let's say it's worth 200,000. He's got 150,000 mortgage on it. He transfers it into his limited company at full market value. He pays the stamp duty, pays any CGT that's due. He borrows 150,000 within the limited company to pay off the charges on there. He doesn't then need to raise the money out of his own bank, put it in his limited company and take it back out again. He can just create a director's loan for the 50,000 pot. The beauty of that is, because this is another question I get asked a lot, we sell it to ourselves at a reduced amount. You don't need to. Sell it at full market value, create a director's loan, because you can then pull that money out as loan repayments and charge the company interest, right? The interest is taxable, but the loan repayments aren't, right? So it's a really tax efficient way of moving a property into a limited company, and you know, all of that sort of stuff is fine. A capital raising, any legal purpose, obviously not gambling debt or tax bills, or ailing a failing business or a speculative enterprise, but for any other legal purpose. So we often get calls, you know, my client wants to raise money to pay off the residential mortgage. Will you do it? Absolutely. My client wants to raise money to do works to the portfolio. We won't allow them to do work to the target property because it has to be occupied within 30 days, but they can capital raise to do work to other properties within the portfolio. So coming back to the EPC question at the beginning, you know, if you've got a property that's already at C, for instance, and you've got 3 properties that aren't, then capital raise on the C property to do the work on the D properties. Right? Absolutely fine with that. I'll take a breath.
I was just going to say, I mean, as far as engaging seminars go and workshops go, Andy, I've got to say, there's not a single question here. And I think that's down to the fact that you everything. You know, I think it's absolutely fantastic, the detail in which you've gone to and you know, extremely upbeat about the sector. And I think that's absolutely amazing. You've answered most of the questions that we had. So my plea to everybody else is we've still got some to come. But if anybody does have any questions, fire them into the chat and we'll pick up on them. Can I pick up on this question that we were talking about earlier, because I found it?
Yes, by all means.
This was a question. I mean, of the other questions, you've answered them all about EPC rating F. You've talked about minimum loan amount, minimum income. Talked all about that. What I would say to participants in the workshop, I would say, and remind you of the depth of information that's available on Knowledge Bank. Even I found those answers. 140,000 pieces of criteria in Knowledge Bank. I know it's a shameless plug, but you all hopefully users. We're updating 3,000 pieces of research every month, so it is up to date. Let's get in there and let's those answers can be found. Right, so with rising interest rates and properties struggling to meet interest cover ratios, what could they do differently? I guess they means you. What could you do differently to help overcome the issue?
Oh, that's a brilliant question. And I applaud whoever asked that question. I applaud you for asking. I asked this question at the beginning of last year, actually, and I was waving a flag and charging around the industry, going, "Guys, this is coming. What are we going to do? What are we going to do?" And it's a conundrum, and it's not easily dealt with because. Look, I'm not. Please don't take me as dissing regulation here. Regulation is there for a purpose, right? And we, whether we agree with it or we don't agree with it, the regulation is there, and broadly, regulation is there to protect all of us. But the regulatory changes have come, and when they came in, we were in an unprecedented long sort of space of very low interest rates, and so there wasn't really a challenge around affordability. The difficulty we've got now, of course, is that because we've had low interest rates for a very long period of time, we've seen a dramatic increase in house prices over the last few years. What's interesting is that rental incomes haven't been increasing as quickly as house prices. So the rental income as a percentage of house price is in effect been dropping, right? So what we have seen, of course, in recent months, and there may be some deep intakes of breath on the call as I say this, but we've obviously seen lenders launching products with much higher arrangement fees. Now, when you look at, I'm not going to go into the mechanics of how we fund a deal here, guys, but you all know that there's a cost to the funds, and then we have to create a profit margin to pay you a prop fee, to pay people like me to do my job, and to make profit for the business, right? So, from what you buy the money in at and what you sell it out at, there's a margin, right? And it's been a difficult time where interest rates have been going up and up and up and up and up, right? So what lenders look at is how do we get that margin? Now, normally you get it through the price of the rate that you're selling, but there's another way of doing it through product fees, right? So one of the things that we've seen in certainly this year is much higher product fees. We've seen lenders do products at 10% product fee. So that's one way of doing it, because if you've got a higher product fee, you've got a reduced interest rate, and through having a reduced interest rate, you've got more affordability. But if you borrow more and the product fee is linked to the amount you borrow, then that's how the lender's making their money. So that's been one way that lenders have looked to address this. But it's a difficult conundrum, because whatever we do as a group of lending institutions, we have to abide by the rules laid down by the PRA. So I think I don't know if I've got the answer. If I had the answer, I'd probably be a millionaire right now, because everybody would be knocking on my door going, "Andy, we'd like to buy this solution off of you." And I thought long and hard about it, and I think it is difficult. Do we get into, people have talked about, maybe offsetting. Is there a way to offset and bringing that back in and using it through the buy-to-let space? I think there's lots of potential solutions out there, but it's difficult. And unless you're a lender that runs a banking institution in the background, there may be offset something you can't offer. I don't know. I think it's a great question, but I'm not sure I can answer it any better than that.
So in that context as well, the additional question that was just asked was can fees be added to the loan?
Well, look, certainly for us they can, right? Yeah. I mean, we don't have product fees as high as 10%, but you know, we can add fees to the loan provided they are covered by the stress test, right? So, you know, one of the things you think about when you're working it out is, you know, I've borrowed X, but in actual fact, I'm funding at Y because I've added my fee on. Is it still covered by that stress test? And we'll work that out. But so yes, the simple answer is yes, we can do it provided it's covered by the stress test.
Yeah. Okay, thank you.
Should we move on?
Question, I was going to say, is the next. No. I think the next slide is a poll.
Well, not quite, but I was going to say, did you know we can lend on large portfolios provided by bespoke service? So I just want to talk really, really quickly, and I'm aware of time. We had a case come in last year where, so our sort of standard criteria is we'll lend up to 5 million to one applicant. But if you've got John and Keith, John borrows 5 million, Keith borrows 5 million, they can then join forces and borrow another 2.5 million jointly. So effective different mix of borrowers can get up to 12.5 million. But we had a client come to us last year with 58 properties, 13 million pounds worth of borrowing on them. Interestingly enough, all of the properties, all the mortgages on them were sat in our back book. So I talked about our Topaz back book at the beginning of the presentation. So they all sat there, so we could see them anyway. Our head of credit is great. He got involved with the client, talked to the client, went and saw some of the properties. We put a proposal through to the funder, and the funder did a bespoke price on this deal, and we lent on all 58 properties, right? So as a consequence of that deal, we're now in a position where if you've got a client that wants to do an individual lend with one lender, we could be a good solution for you, because you know, if you're trying to place multiple deals through multiple lenders, it starts to be a challenge, different pricing, different criteria, et cetera, et cetera, et cetera. Whereas if you can get one lender to look at the whole lot, that could be a really good solution. I know there can sometimes be nervousness around universal charging, where you've got one charge over all of the properties. The difficulty there, of course, is if you want to take one of those properties out of that lending scenario, the lender will not only ask you to repay the mortgages on it, but potentially they can ask you to take some of the money from the rest of the charge, or from the equity to reduce the borrowing across the rest of the properties. That is a scenario that could crop up. The beauty of doing individual with us, we'll do a portfolio lend, but we'll do individual charges on each property, which can be really, really useful. So just bespoke service, bespoke pricing, give us a call. Shameless plug, to use your words.
Yeah, so does that answer this question? One loan or loan per asset on a large portfolio? That answers that question, doesn't it?
Yeah, loan per asset. Yeah, absolutely. Loan per asset.
Absolutely perfect. Good.
So, poll.
Okay, so the poll. Do you want to read the poll and I'll get the... Yeah,
so what percentage of properties are financed through a limited company, an SPV? 35%, 50% or 65%? Be interesting to see what comes in on this one.
I mean, there's a stunned silence from the audience, which is really good for you.
Either that, I put them all to sleep. I'm not sure which.
Yeah. Okay, interesting. I'm going to end the poll in 4, 3, 2, 1. Okay. And share the results.
Ah, okay, that's interesting. That is interesting. Right, okay. So I will share my answers. Now, this is our book specifically, right? If I go back to 2018, you know, really low in terms of inquiry volumes coming through on SPVs, but it's far higher now. And actually, our book balance is currently at 58%. And we see all sorts of things going on in the SPV space. You know, more and more people are taking tax advice on how to make their portfolio more tax efficient. And for those that are in individual names, very often they're given tax advice to move to an SPV. So they can move it through the normal course of selling it straight to their SPV at market value or whatever they want to do, and create a director's loan account, as we mentioned earlier. Or actually, one of the things we're seeing now as well, which I'll just touch on lightly, Jonathan, is incorporation. So there was a legal case back in 2013. It was Ramsey versus HMRC, where Mrs. Ramsey took HMRC to court about whether she should be liable for tax bill, and she actually because it'd been ruled that she should pay. She challenged it and she won the challenge, and it was ruled that she shouldn't pay. And it all came down to a definition of a business, and that particular court case has driven some opportunity within the space in terms of being able to move properties from individual name into a limited company. So broadly speaking, different lenders have slightly different views on the mechanics of this, because it's not specifically picked up in the legal case. If you read through the case, which I'm pretty sad and have done actually, but if you read through it, it doesn't pick up on the detail that we have picked up as lenders. But let's say you've got, again, I'll use the traditional husband and wife team. They own 20 properties. And they are, they're high rate taxpayers. They're paying tax on their income at 40% or whatever, and they've been given tax advice by their accountant to move to SPV, right? And they're sitting there looking at these 20 properties and thinking, blimey, if we move all of these, we've got a massive stamp duty bill, plus we've had quite a few of them accrue value since we bought them, so we've got a big capital gains liability as well, right? How can they get them into the limited company without paying that stamp duty and the capital gain? Well, the simple route through is incorporation. So what they would do in the first instance is they would create a partnership. And for us, we want to see that the ownership structure stays the same all the way through. So assuming they're 50-50 partners at the beginning as individuals, they become 50-50 partners in the partnership, and then 50-50% directors in the limited company. What they would do is they would create the partnership, and the properties would become partnership assets. So one of the things that we asked to see at the point of incorporation is that they have become partnership assets, and we asked to see a copy of the tax advice. After they've sat in there for a year, they can then incorporate. This came up on a recent limited company criteria clinic that I did with Aldermore and a couple of other lenders. But after 12 months, we would then allow them to incorporate. Now, some lenders, I think Aldermore said on the criteria clinic that they would want 3 years. Other lenders like Paragon, I'm pretty sure, don't even need a year, okay? But we would want to see the properties in that partnership for a year. And then after 12 months, they can incorporate, move the properties into the limited company. There's no stamp duty to pay, and the CGT gets rolled into the company as a shareholding, and then it becomes a chargeable event if they dispose of those shares at a later date. So it can be a really cost-effective way of moving properties into a limited company. So we're seeing a lot of that stuff go on. And did you know we can lend to limited companies? So incorporation and partnership, which is what I just talked about. So I think, we're kind of there on the presentation, Jonathan. Shall I stop sharing now so people can see me, and then if we've got any other questions, we can chat them through.
Absolutely. I mean, we've technically got 3 minutes left. And again, without too many superlatives, I've got to say that was one of the most engaging presentations I've ever seen on one of these sessions, and absolutely fantastic. You're, in my opinion, a great walking advert for your employer, and you should be congratulated. I think that was an absolutely fabulous session, and certainly, hopefully, the participants have learned a little bit more about what Zephyr are, and more importantly, what they can offer. So yeah, it says, we've got some feedback already. Great detail, great overview. Thank you. So
you're very welcome.
Fantastic guidance regarding individual and partnership incorporation. So there's some good feedback coming back. So if there are no other questions, what we'll do is we'll draw it to a close. But I know there's a final slide that I don't know whether you want to show. It just got some QR codes on.
No, it's not on this slide deck, actually.
Okay, yeah, fine.
So, listen, look, I guess the message is, Jonathan, if you go onto our website, in the useful docs section, we've got our All About Zephyr guide, which is our criteria overview. We've got our product guide. There's information about our ICR and stress tests. There's contact details for all the BDMs and the RSMs. We pride ourselves on being really, really friendly. And actually, one of the things that I always say to all of my brokers I look after, and anyone who's ever dealt with me will testify to this, that if I can't answer the question, I will go and speak to our head of credit and get an answer for you. But also, if we can't do it, and I know of a lender that I'll try and point you in that direction, because for me, we're an information business, right? We all need. That's exactly what you sell. You sell information, and for me, I will say to somebody, if you thought of using this lender or that lender, and they can go back to Knowledge Bank and check it out, or phone them up. So we do believe in trying to help brokers get cases placed, because more cases you place, brokers are in business. We won't have redundancies like we were talking about earlier, and we'll all keep going as an industry. So, reach out to us and lean on us, and that's what we're here for.
I've lost you. Is it my signal? Can you hear me?
Yeah, I can hear you.
You can still hear me. So look, I'm going to call that a wrap. So thank you very much indeed. And, may your business increase from the participants.
Lovely job. Thank you very much. And I hope to speak to you soon. Thanks,
Thank you, everybody.
Cheers.
Bye.
Bye now.